We detected an unusual trade worth $5.5 million on Adobe stock, ticker symbol ADBE, on the most recent trading day. But here's what makes it more interesting. Adobe reports earnings in a few weeks on March 12th. And so in this video, we will analyze this unusual option activity to find out if this wealthy investor is bullish and buying ahead of earnings or bearish and selling before the earnings report is released. Because as we all know, the rich have better access to information, sometimes even leaked insider information, such as earnings reports, to make better financial decisions. No wonder the rich get richer. And so to level the playing field, let's dive into our analysis to gain insights from the rich so that our subscribers and members can profit from this deep knowledge too. As we can see here on the options time and sales tape, the most unusual trades happened on February 25th at 3:11 p.m. at the 36-second mark for these July 18 options at the 550 strike calls and the 660 strike calls. 6,493 contracts were being traded for a price of $10.55 and $198 each. And so we can calculate the total cost of this trade, the price of $10.55 subtract by $198. Keep in mind that options are priced per share, so we need to multiply by 100 since each options contract represents 100 shares of stock. And so each trade costs $857. And since there was a quantity of 6,493 contracts, we multiply that out and we get a total of $5.5 million for this trade. But keep in mind, the earnings report is being released in a few weeks, so this is a higher risk trade in comparison to the trades that we shared on our website. And so if you want to get access to the lower risk and higher probability of profit trades, then go to our website. We'll put a link to our website up here where you can get deep insights into exactly when and which stocks wealthy investors are trading on Wall Street so that you can have the same opportunities as the rich. Because if the rich get richer, why shouldn't you? Now, with that said, even though this is higher risk, we still traded this, but we use position sizing to manage our risk. As you can see here on the options chain, for the July 18 options at the 550 strike calls, since this was a new opening trade, we also bought these call options and got into the same position here. POS stands for our position, and the green color means a buy position. And a red color means a sell position, which is what we did by selling the 660 strike calls, as you can see here. Now, how did we know these were new opening trades? Well, if we take a look at the historical data on February 24th, one day before these unusual trades were made, you can see that for the July 18 options at the 550 strike calls, there was only 186 contracts that were open interest. And for the 660 strike calls, there was only 10 contracts that were open interest. And so if we take a look at the updated data now for these July 18 options at the 550 strike calls, notice that the open interest has increased. And that's why we also opened a new position here by buying these call options. And for the 660 strike calls, notice that the open interest has also increased. And so the fact that the open contracts for both of these options have increased by more than 6,000 contracts that we detected on the most recent trading day, we know that this wealthy investor was opening new contracts and not closing out contracts. This data is very important to figure out because if a wealthy investor is closing out trades or contracts, it could mean they're worried about that stock So maybe it's not the right time for us to jump in. On the flip side, if a wealthy investor is opening contracts, it could signal an opportunity for us to start a new trade. And so we always take this extra step to analyze the data at a deeper level because many other websites and scanners don't. They report all high volume unusual trades without filtering out closing trades, which leads to wrong results and losses for those following unusual option activity. And that is why we have more winning trades than other websites. Now, with that being said, not all of our trades will be winners, but as long as we diversify our portfolio with high quality stock picks backed by strong data analysis, then we can stay consistently profitable in the long term. And so, based on our deep research and analysis of multiple variables and data sets, which we do not have time to cover in this video, this wealthy investor bought the 550 strike calls and sold these 660 strike calls, opening a trading strategy known as a vertical call spread for 857 each, the same price as we calculated and saw earlier on the options time and sales tape. And so when we analyze this trade, you can see here on the risk profile profit loss graph where the x-axis represents the share price of the stock, which is currently trading over here, and the y-axis represents the amount of profit or loss. Note the zero break-even line here. And so when the purple line, which represents the current date, and the blue line, which represents the option's expiration date, are trading below this zero break-even line, this trade becomes more negative loss. And if it trades above it, this trade becomes more positive profitable because this is a long bullish trade. And we can confirm it here on the Greeks. We have a positive delta trade. If it was a short bearish trade, it would be a negative delta. But be aware of the risk of this trade. We have a negative theta decay, which means that as time goes on, this trade will lose in value. And that is why you can see here the purple line drops down lower to the blue line as we approach the option's expiration date. Since these options lose value through time, the break even on this trade moves higher as time goes on. And so you can see here, even though the call options we bought have a strike price of $550, the stock needs to trade above $559 per share for this trade to be profitable at expiration. Due to this risk, including earnings coming up, we only took a small position in this trade. We don't invest a lot of capital into these higher risk trades because we invest most of our capital into the lower risk, higher probability of profit trades that we share on our website. We'll put a link to our website here where you can also learn more trading strategies to reduce risk while increasing profits. Let us know in the comments below. Do you think Adobe stock will rally after earnings, or do you think it will crash down? As usual, please hit the like button, subscribe if you haven't, take care, and have a wonderful day.